All right, so now we're going to talk about debits and credits, and I think that this is probably where we really start losing some folks, and people really start kind of feeling like this may be a bit much. But I really want you guys to understand debits and credits. I really want you to understand that it's not as difficult as it seems, and there are some tricks we can use to make it easier to remember what gets debited and what gets credited. Okay, so debit and credits basically are how we represent impacts on the accounting equation. Okay, you can see here we've got the accounting equation listed out again. You'll see that we're showing that assets increase with debits, liabilities and stockholders' equity both decrease with debits. So we got a little difference going on there. Don't worry, we're going to talk about this in depth. So it's very, very, very important to understand this part. A lot of people get very hung up on assuming that debits mean increases and credits mean decreases. That is not the case, right? Debit and credit means something different to Walmart than it does to a bank, okay? Banks are going to take an opposite outlook, an opposite approach to debits and credits, okay? For us, all you need to know, debits mean left, credits mean right. So debits on the left, credits on the right. And I'll give you guys a mnemonic here shortly to kind of help you remember all of this. But if you just remember debits on the left, credits on the right, okay? And this right here is just shorthand, right? DR equals debit, CR equals credit. So if you see me writing those, that's all I mean, okay? So DR for debit, CR for credit, okay? So debits and credits, we use them interchangeably. Okay, we use them to either increase or decrease different account types. And that's why I'm telling you guys, as we move further in the class, we may pull the reins back on debit and credit talk and talk more about increases and decreases, because it's really all we're doing. However, there are some things in accounting where you need to understand if an account is debited or credited in order to really understand it. Okay, so this last little bullet point, a couple of bullet points here, right? Debits can increase or decrease an account. It just depends on what the account is. Same thing with credits. They can increase or decrease the value of the account. It really just depends on what the account is. Okay, so each account we say has a normal balance, what we refer to as its normal balance. And that just means if it has a debit, if it uses a debit to increase the amount of the account, then we call it a debit normal account. Okay. If it has a credit to increase the account, we call it a credit normal account. Okay? It really is us just saying, hey, this increases with a debit or increases with a credit. It's shorthand for accountants. You will hear us say it a lot, particularly if you go above 201 level in accounting. So you'll hear me say, this is a credit normal account, or this is a debit normal account. So you know when you're looking whether or not you should end up with an ending balance in the debit or the credit side. Okay. We use these things called T accounts, and I love, love, love T accounts. I am in love with T accounts. I can't draw hearts very well. I don't know if you noticed, I'm not very artistic or creative. My excuse for that is accountants that are artistic and creative typically are the ones that get to be artistic and creative in prison because they're finding new and fun ways to steal money. So these little goofy things I'm doing, I apologize if the art is horrible. But anyways, we use these things called T accounts, and I love T accounts. I still use T accounts to this day. You can talk to partners at CPA firms that will tell you they will still bust out a T account and use it. For me, it's a format that I use to easily follow the flow of the transactions, because as we get further into these classes, and especially if you go on to like accounting 301 or 302, the transactions are going to become incredibly complex, okay? And it's just easier to find your ending balances with accounts. It's easier to follow the flow of a transaction if you use what we call T accounts. So they include a title at the top, okay? And they have debits on the left, credits on the right, okay? And then you'll have your total line, and whatever's in under that total line is going to be the ending balance. This is typically what you will see. Here's how I like to draw them. So let's say we look at cash. I would write cash down, and then I would draw a T account, just like that. It looks like a T, right? That's why we call it a T account, okay? And I know that cash is an asset, and I know that assets increase on the debit side and decrease on the credit side. So anything I write on the left side is going to be an increase, and anything I write on the right side is going to be a decrease. I would net those together, and I would get a $200 ending debit balance, meaning cash has a debit normal balance. Okay, so now you're kind of starting to see why we use those terms. Now, I'm going to use a lot of these terms. Like I said, as we move forward, I'm going to try and just talk in terms of we increased cash by $500 and we decreased it by $300. Okay, I would still like you to know that we did those with debits and credits and how we did those, but I think talking about them in terms of increases and decreases may help us with some of our retention and understanding. So we're going to lay it all out for you right here. These are the big three, right? These are the three we need to know. Okay, so asset accounts, assets increase with a debit. Okay, assets decrease with a credit. This means that asset accounts are debit normal. Okay, liability accounts, okay, they increase with a credit and they decrease with a debit. These are credit normal. Okay. Stockholders' equity increases with a credit and it decreases with a debit. Again, hopefully you've caught on. These are credit normal accounts. Okay. The way I like to remember it, and this is one way to remember, I'll give you several ways to try and remember which accounts get debited and which accounts get credited. I like to, shocker, write down my accounting equation. Anything that lives on the left side of the equation gets increased with a debit. Anything that lives on the right-hand side of the equation gets increased with a credit. Okay? And remember what we said, debits equal left, credits equal right. So again, anything on the left is increased with a debit, anything on the right, increased with a credit. That is one easy way to remember that. Now, there are two exceptions to this, and we will talk about them and why it makes sense. And you can still use your accounting equation to figure that out. Okay. So, retained earnings. We have components of retained earnings. We have revenues, expenses, and dividends, right? Revenues and expenses equal net income. Okay. Recall that expenses are going to be a negative number, and dividends are going to be a negative number. That's why you always see me write those like this when I'm writing out my expanded accounting equation, right? Why? Because these two reduce or decrease retained earnings, okay? So I always kind of represent them as a negative. Even when they're increasing, I like to put that they're a negative. It helps me remember that in the long run, they're going to reduce retained earnings, which is going to reduce our equity, okay? So our retained earnings calculation is going to be our beginning retained earnings, and it'll often be presented to you like this: beginning retained earnings plus any net income that you have, which, if we recall, is revenues minus expenses, okay, less any dividends that you had. That's going to equal your ending retained earnings, okay? So just remember this calculation here: beginning retained earnings plus your net income minus dividends equals retained earnings. And we've talked about this. This is something that we've mentioned before. Retained earnings really is just your net income that's left after you've paid dividends, right? We've talked about that. So this makes sense, right? Net income less your dividends is your retained earnings, your ending retained earnings, but you need to add your beginning balance to that, right? If you started the year with $100 in retained earnings, that needs to be added, okay? Revenues increase retained earnings. Retained earnings is a credit account, so we're going to in turn increase revenues with a credit. Again, revenues are going to be a credit normal account. Okay. Revenues are going to decrease with a debit. That just makes sense, right? You're going to do the opposite to decrease it. Okay. So expenses decrease retained earnings, right? Remember, I always say that I write expenses like that when I write out the accounting equation, because this means that they are negative, right? because they are decreasing our retained earnings. So if we're doing the opposite, if we increase retained earnings with a credit, we need to decrease it with a debit. And if expenses decrease retained earnings, they're going to be a debit. We increase expenses with a debit. Expenses are a debit normal account. Okay? Meaning we decrease expenses with a credit. Again, though, if you recall from the earlier video, I said typically we're not going to be decreasing expenses until we close the books, and we'll talk about that later in chapter 4. Okay, so what I'm telling you here is this is one of those exceptions, one of the 2 exceptions that we have. Recall that I said assets, anything on this left-hand side of the equation is going to increase with a debit. Anything on the right-hand side is going to increase with a credit. There were 2 exceptions. Those exceptions, one of them is your expenses. Okay. And remember, I write it like this for a reason, right? Because an increase in this eventually becomes a decrease in your retained earnings. So an increase in expenses is a decrease in retained earnings. And this video is getting a little bit longer, but we'll go ahead and finish this portion of it, and we'll move on to the next one on the next video. But dividends are the same as expenses. They're not expenses, but they behave in the same way. Dividends are going to decrease your retained earnings, okay? So again, since we increase retained earnings with a credit account, since retained earnings is credit normal, right? We have credit normal. Then we need to increase dividends with a debit, okay? Meaning that dividends are debit normal. Okay, and again, we'll just walk through why that is. We'll write down the accounting equation. Again, you can solve this just by looking at the accounting equation. So we've got A equals L plus E. You got common stock, and then your retained earnings. Then you've got net income and dividends. And again, remember, I always write this as negative because I want to remember that it's decreasing my retained earnings. So if dividends increase, if I'm paying more money in dividends, that's less of my net income I get to keep, which reduces my retained earnings. Okay, so this is the other exception. Remember, I said that anything on this left-hand side of the equation is going to be a debit increase. Anything on the right-hand side is going to be a credit increase, except for dividends and expenses. They're going to increase with a debit. So in the next video, we'll talk about some mnemonics you can use to help you remember that.